back to Finance 3000 week 7 of our study. Sorry again for being late for office hour tonight. I just posted the recording under week 6 folder. Make sure that you spend some time doing the questions yourself. Check the answers. Watch the recording for the difficult questions where I go over some more hints on the more challenging ones, and if you still have a question, reach out to me. Starting in chapter 6, which is week 7 and week 8, we are starting a really important yet a little bit confusing topic about bonds. We know bonds is fixed income security, and as a fixed income security, they don't get as much attention as the equity market. And when they get some attention, it's usually how is the feedback effect from the bond market to the equity market. When the treasury yield is higher, how does it affect the NASDAQ? But there's actually a lot of details in bond and the bond market. And the bond market, because of the close ties to interest rate, it's really closely related to the general health of the economy. From this chapter, I want to give you some basic understanding of what is a bond about. What is a bond as a financial security, and how is it priced? And how does the movement in the bond market relate to interest rate in the economy? And how does it tell us about the general conditions of the economy? Okay, and besides, the bond has a lot of terminologies that is specific to bonds. And after this chapter, I hope you can read the financial news about bonds more fluently, and you know what is about what, how the prices are quoted, and etc. All right, again, pay special attention to the middle of the lecture where I start to talk about the relationship between interest rate and bond prices. And I also have some newsletters I clipped from the web, especially comparing the conditions, the interest rate environment back in spring 2020 and this spring right now. Okay, this is actually a really perfect time for us to talk about bonds because of all the activities going on with Fed and the Treasury market. Feel free to reach out to me if you want more supporting resources about bonds, or if there's any other topics that you're interested in covering. I'll try to put it into the course one way or another. All right, and apologize on an editing mistake by the end of the video. I forgot to turn off that iPad where I use as a calculator. Hopefully it doesn't affect much, and if you like, you might just pull up the slides in front of you while listening to the recording so that your view is not distracted. All right, learning in process, that's it. This is chapter 6. In this week and the next, we're going to talk about everything about bonds. From chapter 5, we already know what is time value of money and how to calculate the present value of any stream of cash flows if you give us the discount rate. And even earlier in chapter 1, we have defined a financial asset as a bundle of future cash flows. A financial asset has value not because it can produce anything like a real asset, but because owning the asset gives us claim to a stream of future cash flow, so this financial asset is valuable to us. The value of any financial asset can be determined by the present value of all of the future cash flows this financial asset includes. In order to give a present value to any financial asset, we will need all of the detailed future cash flows, and we will need an appropriate discount rate to discount those future cash flows. Now we are ready to use everything we know to price a financial asset we have in mind. In this chapter, we're going to price bonds, and in chapter 7, we're going to talk about stocks. Why is valuation interesting? Why is pricing a central topic in any financial course? As an investor, we want to know whether we should buy or sell a certain financial asset by comparing the price that is listed today with what the price should be. if we were a corporation, we also want to know if we were to issue stocks or bond in our financing decisions, how much we can get from the market. Here, I want to make a distinction between market price and fair price or intrinsic value. Market price for anything is determined by the market as an equilibrium result from supply and demand. Remember the chart where there's a supply line and there's a demand line. When they cross, there is an equilibrium price and quantity for any goods. But the value is different from the price. The value can be different from price. And in fact, in economics, we know that the price always fluctuates around value. Value is the present value of all of the future cash flows, but price is an equilibrium result from supply and demand. They can be the same, but they can be different. And our purchase or sell decisions as an investor depends on how much does the price compare to value. If it is overvalued, meaning the price is much higher than the intrinsic value, it's a good place to sell. And if it is underpriced, the price is lower than the value. So we should buy. This chart summarizes the two most important type of financial asset we're going to talk about, debt and equity, bonds or stocks. Have a good read of the table, pause the video and read all the words. We're going to come back to this table as we go into the discussions. Chapter 6 have a lot of content, so we separate it into 2 weeks. In this video, we're going to cover part 1, and in the next week's video, we're going to cover part 2. Nowadays, all financial assets are digital. We can no longer touch a piece of paper and call this our financial asset, at least not in the most of the cases. But this one we're looking at is what a bond would look like in the old days. Actually, it was a municipal bond issued by the city of San Francisco. It was issued on November 1892, and it was due to repay. Its maturity date is May 1st, 1895. At the maturity date, $1,000 of face value or par value is going to be repaid. And before the maturity date, after the issue date, the bondholder is entitled to receive 6 coupons. Because in the U.S. Treasury Department, in the U.S. municipal bonds, in the U.S. actually most of the bonds is paid on a semi-annual basis, meaning that there's 2 coupon payments per year. You see the smaller clips down below? Actually, in the old days, a buyer of the bond, is going to clip one of the coupons off and physically mail it to the issuer of the bond. And then the issuer is going to mail back a check of the coupon payment to them. And this piece of paper is literally worth all of the future cash flows from the bonds. And this piece of paper is literally worth all of the future cash flows from the bonds. When a corporation or other type of institutions such as the government need to raise financing in order to finance their investment decisions, bond financing is one of the ways they can do. Well, in financing decision, they can either raise equity by issuing stocks or to raise debt by either selling bonds to bond investors or arrange a bank debt with a bank. Bonds and bank debt are both debt financing. The difference between bonds and bank debt is that bank debt is typically a bilateral agreement, a contract between the borrower and the creditor. But the bond is a financial security, which means you can buy it and sell it in the secondary market.
We hear news about the stock market all the time, but actually the bond market in the US is a larger market compared to the equity market. And a difference between bond trading and stock trading. Stock trading typically happen on an exchange, and bond trading are usually happening over the counter, meaning that each bond trading is negotiated between the issuer and the buyer, instead of being issued at a standard level and listed on the exchanges as stocks do. The bond market is even larger when interest rate in the economy is low, because interest rate represent the cost of having a debt financing. Now let's go over some bond terminologies. Like any asset, there is the name for the financial asset, the bond. There is the borrower using the financial asset to raise money, the bond issuer. And the investor who provide financing, the bondholder or investors, and the financial intermediary who facilitate transaction between the issuer and the investor. Well, we know the bond is a debt security. Okay? It obligates the issuer, the borrower, to make specific payments to the bondholder, the investor. Sometimes we also call bonds debentures or notes or bills, depending on whether it's collateralized with assets backing the bond payment and the maturity of the bond. Not only corporations, but other institutions such as the governments can be a bond issuer, can use the bond financial security to borrow money. Actually, the US federal government is the largest issuer of bonds. If they issue a bond, we call it the treasury bonds. The treasury bonds have a really big market, and it's actually the main player in the bond market in the US. Other municipalities like states, cities, and counties even can issue their own bond called municipal bonds. And of course, corporations can issue corporate bonds. Anyone who purchases the bond security is called the bondholder or the bond investors, entitled to receive future payments from the bond, including coupons, and if they hold it until maturity, the principal payment. And bond dealers is the financial institutions or any financial professionals who buy and sell bonds in the secondary market, providing liquidity, facilitating transactions. The cash flow associated with bond have two types. The first one is called coupon. You can think of coupon as very similar to a interest. It's a periodical recurring cash flows that the bondholder is entitled to receive. Remember that little coupon that we actually clip off from the bonds in the old days. It's a periodical cash flow. And the face value is what a bondholder is going to receive by the end of the bond's life, which we call maturity. If we call a bond a 10-year bond, its maturity is 10 years. And 10 years after today, if today was the bond when the bond was issued, is the maturity date. The maturity is when the bond expires and the face value is due to be repaid. So the special thing about the bond is that it always repay a fixed amount of face value at maturity, and the coupon is always a fixed percentage of the face value, which is what we call coupon rate. The face value, if not otherwise specified, is typically $1,000. Pay special attention to coupon rate. The coupon rate is always an annual interest rate. It's a quoted annual interest rate, very similar to the APR that we discussed in last chapter. But even though the coupon rate is quoted as an annual interest rate, the coupon can actually be paid in frequencies such as annually, semi-annually, or even quarterly. For example, if we have a 10% coupon rate bond with annual coupon payments, we know that 10% of $1,000 is paid every year until maturity. But if the coupon was paid as a semi-annual frequency, we know that this $100 is split into 2 payments over the year, $50 every half year. Similarly, if the coupon is paid quarterly, this $100 is split into 4 equal payments of $25 a year. Okay, so the coupon rate is always the annual interest rate, but the payment frequency can differ. In the US, most cases the bonds are paid with semi-annual coupons, but in Europe, it's typically paid annually. And in class, we're going to have examples about both cases. Bond is a financial asset. As an investor to any financial asset, we want measures of its return so we can compare this return from other investment opportunities we have. If we buy a bond at one point of time and we plan to hold the bond until maturity, then we will use the yield to maturity as a measure of our investment return on an annual basis. The yield to maturity is defined as a quoted annual return if we buy the bond at market price now and hold it until maturity. Maturity meaning the day when principal is paid and the last coupon payment is paid. Okay, and we're going to devote a whole section in calculating yield to maturity later, but I just want to introduce those 3 measures of return for bonds specifically. And yield to maturity is specific to bonds. You don't see this name for other financial securities. But what if we buy the bond as a financial asset in the market and we plan to sell it before the maturity? Then we have other 2 measures of return for our investment. The most generic one being the bond rate of return. Okay, if we cover the word bond, the rate of return can be measured for any investment over any duration of time. The bond rate of return is the total income per period per dollar invested over the period we have. If we buy the bond at purchase price and after a while we sell it at our sell price, a bond rate of return will be the total income we have received while holding the bond, which includes the coupon and our capital gain or capital loss, per dollar of initial investment, which is a purchase price. Okay, this is the bond rate of return. Another way to measure part of the return is called the current yield, which focuses the cash flow we get from coupons. The current yield is defined as the annual coupon payment, which equals to the coupon rate multiplied by principal value divided by bond market price, whatever the bond market price may be. Okay, we're going to devote a whole section into bond rate of return and yield to maturity, comparing the 2, giving quantitative examples. But let's first see how do we calculate the current yield. Example, what is the current yield of a 10% annual coupon bond, meaning the bond is paying coupon every once in a year, with a 1,000 face value, which matures in 3 years. The market price of the bond is $1,200 now. We know the formula: current yield equal to coupon rate multiplied principal value divided by the bond market price. Just put everything into number. Okay, the coupon is 10%. 10% multiplied by 1,000, we have 100. The bond market price is 1,200. 100 divided by 1,200, okay, we have 0.083 or 8.3%. This is the current yield. It basically measures the income you can get while holding the bond, the cash flow you have while holding the bond, on an annual basis as a percentage of the market price right now. Once the bond issuer issued a bond, this financial security can be traded in the secondary market where people can buy and sell this security, and then pricing information becomes available. To get the prices of a particular bond, we go to a financial portal such as the Wall Street Journal and we find which issuer, which type of bond, and the pricing information is public information. The price for bonds is usually quoted as a percentage of its face value, which is $1,000 in the most cases. For example, if we were looking at treasury bonds, which are the bonds issued by the US federal government, and we can see that the price is around $100, which means 100% of that $1,000. To get the actual price, we use the quoted price to multiply $1,000, as we're going to see examples later. And once we look at this table, we zoom in on a treasury bond with maturity by the end of suppose we were at November 2015. We are looking at a bond which matures in 3 years. This November 15th, 2018 bond with 1.25% coupon rate. It has two prices. One is called the bid price, and the other is called the ask price. These two prices exist for any financial security or any commodity actually in the market where there is a dealer, a financial intermediary who are making a market in this security. When someone want to buy the bond, they submit a bid to the bond dealer. They're offering to buy this bond for 100.1484% of the face value. And people who already have this bond want to sell it, and they offer a ask price to the same bond dealer. And the ask price is 100.1641% of $1,000. You can see these two prices are different. It's similar logic that when we are, for example, looking for a house, we submit a bid to the house, and there could be multiple bids for the same house. And the seller of the house have an ask price, their listing price. And these two prices are typically different. And typically we see bid price is always lower than the ask price because we want to buy for less than they're asking for. So in finance, the bid price is defined as the price investors receive when selling the bond. Okay? Because you are actually, if you have the bond and you are ready to sell it, you can only sell it at the price where the potential buyers want to buy. Right? But when you are a seller, you have an ask price. Someone is ready to buy this from you, they got to pay your ask price. The price investors pay to buy bonds. And these two prices is different. As later we're going to see the difference between the two prices is called the bid-ask spread. And that is actually how the bond dealers, the financial intermediaries, make a profit by charging a spread between bid and ask spreads. Their compensation for making the market, for bringing the two parties to each other. Okay? And as we discuss yield to maturity, we know this is a return that we calculate that if we buy the bond today and hold it until maturity, what is our annualized return? We use the ask price to calculate yield to maturity. It's because the ask price is actually what we can get the bond with, the price we can buy it now. Okay, so we're using ask price to calculate yield to maturity, and in the pricing table, you usually can see the last column as the ask yield to maturity. Let's see one example. How much would an investor pay to buy a 1.625% treasury bond of 2022? It means there is a treasury bond issued by the US government, matures in the year 2022 with a coupon rate of 1.625%. And the second part of the question, if a treasury bond costs $1,106.25, how would this price be quoted in the market? How much would the investors receive if he sold the 3% treasury bond of 2044? And all the information is available in the previous table. From the table, we can see that the ask price for the 2022 treasury bonds is quoted as a percentage of the face value. If we go back to the table, the 2022 bond have a price of, the ask price is 973,047. And we use this as a percentage of $1,000 to find the actual ask price, which is what an investor would pay to buy this bond. And if the price of a bond is $1,106.24, it's going to be quoted as a percentage of $1,000. You use this number to divide $1,000, and you get a percentage, which is 110%, 10.625%. This is how the price is going to be quoted in the financial portals. And also, similarly, the bid price for the 2044 Treasury bonds is the listed bid price multiplied by $1,000, the face value. Okay, this is a norm of how pricing information for a bond.
Now we are ready to talk about bond pricing. By now, we already understand the nature of any financial asset. Any financial asset is nothing more than a bundle of future cash flows to be discounted to its present value equivalent by an appropriate discount rate. For now, we take the discount rate for granted. We take it as given. And later, in Chapter 11 and 12, we will associate the discount rate with the amount of risk that is contained in this bundle of future cash flows. If we have a bond, we know the bundle of cash flows have two parts. One part is the recurring coupon payments we're getting every year, every half year, or every quarter, depending on the coupon payment frequencies. And by the end of the maturity, we have a lump sum of the par value. For example, if we have a 3-year bond, which matures after 3 years, we're standing at year 0, we're drawing a timeline of the cash flows. It will look something like this. By the end of the first year, we have the first coupon. By the end of the second year, we have the second coupon. By the end of the third year, we have the third coupon and the par value of $1,000. Put those into numbers. Suppose we're standing at the year 2018, and we decide to buy a 2.25% coupon bond maturing 3 years later in 2021. And then we can put the cash flows on a timeline. Time 0 is the year 2018. Time 1 is 2029, where we're getting the first coupon payment of 2.25% multiplied $1,000, which is $22.5. By the second year, 2020, we get the second coupon payment. By the third year, which is the year of maturity, we have the last coupon payment and $1,000 par value. Here we have the annual coupon paying bonds. Okay, and suppose another bond. We were at the year 2015. We look at a bond with 1.25 coupon rate maturing in 2018. So the cash flow is very similarly constructed. At the start of the time, we pay the price of the bond. We have a cash outflow, and in the following 3 years, we have our coupon payments and par value. Okay, now we understand the structure of the cash flow of this financial asset we call bonds. Now, pricing it is as simple as discounting all those future cash flow back to the present. So the first option of bond pricing is simply to discount all of the future cash flows back to the present if we were given the appropriate interest rate. Right? The present value of the bond equals to the first coupon payment discounted once, second coupon payment discounted twice, and by the end of the year, the last coupon payment and the par value discounted t times. And here we are also showing the annual coupon payment. Okay, this is once per year, and the coupon discount rate is for each year. But this is more generic if we were looking at a semi-annual coupon payment, as long as the coupon amount, the periodic cash flow, the recurring cash flow, matches with the discount rate, we're good. If we're using semi-annual coupon payment as cash flows, we gotta use the semi-annual interest rate for discount. And the number of periods is going to be the number of half years, as we're going to see in multiple examples later. Putting things in number, we have the present value or the price of the bond equals to the coupon payment for each year. So here we have an annual coupon payment. And we know the discount rate is 1.194%. It is given to us. Okay, and later as we're going to see that this is the opportunity cost of capital. What is the return offered by another bond of same level of risk that is maturing at the same time? For example, another treasury bond with 3 years left in maturity. We discount them one by one, and using our calculator to calculate the number, add them together, we get that the bond has a price of $1,001.62, and we know it's usually quoted as a percentage of $1,000. Because the bond is really a bond of cash flows, and the first group of cash flow is a recurring payment of the same amount, the coupon payments. We can view it as an annuity. And we already learned how to calculate the present value of annuities using a shorthand formula. So we can use that formula in bond pricing. And the second part of the cash flow is the par value. It's a single future value. So we can use the future value present value formula to discount it back to the present. And then we sum up the two parts of the cash flows for the total present value of the bond. Right? So we know that the present value of the bond equals to the present value of all the coupon payment streams and the present value of the face value. Then we can use the coupon payment, which is a recurring cash flow, multiply the annuity factor plus the face value multiply the discount factor. Plug in the numbers into the formula and we can get the same answer for sure. Make sure you be able to verify this answer using your own calculator, starting from the bracket, from denominator to the numerator, and starting from inside out. And of course, we can use a financial calculator for it. It's actually the recommended, easier way to do time value of money calculations. That's also why we're introducing the financial calculator in these two chapters. Now, let's see how it's done in the financial calculator. Before we start, make sure you clear the financial calculator by hitting second, clear work, clear. It was brought to my attention that in some of your calculators, doing this does not clear all of it. And you might have to push second and clear TMV, which is the button on FV. So to clear everything that is stored in the financial calculator. Well, it's brought to my attention by some students because you keep getting the wrong answer. So to be safe, every time we start, we hit second clear TMV, second clear work, and then another clear. Okay, make sure that nothing is stored before we enter the new numbers. The question asks, what is the price of a 1.25% annual coupon bond? With a 1,000 face value, matures in 3 years. Assume a discount rate of 1.194%. Here we know it's an annual coupon payment. It's an annual coupon bond, meaning the coupon is paid once a year. So we have the number of years as of the number of years, n equals to 3. Here, n equals to 3. And then the interest rate is the annual rate, which is already given to us. We enter the number before the percentage point, 1.194. Okay, and this is IY. PV is what we are solving for. The PNT is the annual coupon payment. Here, everything is annual. 12.5%. 12.5 PNT. This is a recurring payment for every year, from year 1 to the end of maturity. And we have 1,000 as face value. Hit compute, PV. Okay, here we get the present value of the bond, which is also the price of the bond, is $1,001.64. And here we summarize the mapping between the financial calculator time value of money buttons and bond terminology. We know the future value is always the par value, $1,000. The price is the market price, the fair price of the bonds today. And those three buttons, number of periods till maturity, discount rate per period, and coupon payment per period, always have to match each other. This is very important, otherwise we enter into an error from the financial calculator. If we're doing semi-annual coupon payment bonds, this payment is half of the coupon per year. And the N is twice of the number of years because it's half years. And this interest rate is the discount rate per half year. We're going to see more. We know the coupon rate is always quoted as an annual interest rate. But in the US, treasury bonds and some other corporate bonds typically pay coupons twice a year, meaning at each half-year point. So what changes the situation? The only change is that the same amount of coupons over the life of the bond is split into twice as many payments with half of each. It is still the same amount of payment, but the timing of the payment changed, and the amount of the payment at each point of time changes. And of course, it's going to have some effect on pricing and on present value because we already understand that the timing of cash flow matters. Time has a value, money has a time value.
Let's look at one example. Suppose there is a 1.25 coupon bond maturing in the year 2018 and we're standing at 2015. The bond pays semi-annual coupons, so there were two payments of half of the coupon rate each year. The coupon at each point of half year is the coupon rate multiplied the par value divided by 2, which is $6.25. What should be the price of the bond if there is a semi-annual discount rate of 0.597% and the coupon rate the coupons are paid semi-annually? We already know. Given the timeline like this, we know that the price of the bond today will be the total of all of the future cash flow's present value. So one way we can do is to discount each single cash flow back to the present and then sum them up together to get the present value of the bond today, which should be the fair price of the bond. Okay, we know the first coupon at 6 months is discounted by 1 plus R, which is semi-annual rate, okay, to the power of 1. The second one at the end of the year is discounted by 1 plus R to the power of 2, because this is a semi-annual rate. So we have 2, which is 2 half years, and this is a half year cash flow. Doing this until the last year, which is a maturity, the maturity is 3 years away, which is 6 half years away. So the last point of time is 6. We have 1,000 par value plus the last coupon payment. Then discounting it one by one, we get the present value to be $1,001.65. And we know it's usually quoted as a percentage of par value. If we compare the price of semi-annual paying coupon bonds with the price we calculated for the same bond if they pay coupons annually, we can see that the price is slightly higher if they paid coupons semi-annually. Think about why. It's because we get this first $6.25 6 months earlier than the annual coupon payment bond. So each $6.25 is get in the middle of the year rather than by the end of the year. We're getting cash flow earlier, so they have a higher present value to us. Remember that the present value of a future cash flow decreases with the length of time in future that we're expecting it. Now let's do it with the financial calculator. Clear everything from before. Okay, perfectly cleared. N is 6 half years. I is 0.597, which is a half year rate. coupon payment is 6.25. That is the coupon every half year. Future value is $1,000. Okay, note here, we always have the future value as $1,000 because that's the additional money happening only at the end of the time frame. The last coupon payment is already absorbed into the PMT. You don't need to add the last coupon payment because in the previous slides, we know that we discounted the last coupon payment together with $1,000 because they happened at the same point of time. But in the financial calculator, PMT already take care of the last coupon payment. Now we have everything entered. We have compute PV. Okay, this is our answer. If we do 2 decimal points after 0, we have 6.5. Ignoring the minus sign, and that is the answer. Now we're going to start a really important topic, the relationship between interest rates and bond prices. This is by nature quite confusing topic, and we want to take it slow, make sure we have the solid foundation before moving forward. Having a firm grasp in this concept also helps you when you read all those information from the news about interest rate, treasury yields, what Jerome Powell says, and what does the Treasury Department do. Okay, let's go back to the fundamental pricing formula we have from this course. For any investment, we have present value of a future value equals to the future value adjusted by this discount rate. Okay, and we call this whole part the discount factor. Well, we know that $1 today worth more than $1 tomorrow. If you want to delay us a payment, you got to give us a return. We need to be compensated for this delay in cash flow. So that if we are giving up present value PV today in exchange for future value at time t, we need to be compensated with a return R per period. Okay, R is the return we require to make this investment per period. And how does the R change? Well, R basically depends on how risky this future cash flow is. If we are sure about the cash flow, it's a done deal, and we're certain that we're going to get it at time t, we might be compensated less. We might be okay with compensation, less compensation. Like bank debt, like treasury bonds, we require a less return. But if it's a highly risky investment, for example, the stock from a small company, we need to be compensated with a higher return. Because as human beings, as a rational investor, we're risk averse. If we're taking more risk, we need to be compensated more. And R, well, then how do we determine the R? Given the risk level, how do we determine the R? That's the central topic in our third part of the course, but just a preview. This R reflects the opportunity cost of our capital today. What we give up in order to make this investment today. In other words, in order to make this investment today earning return R, what is the return we didn't earn from another investment with the same level of risk? In a competitive market, all investment with the same risk level should compensate the investor with the same level of return. Otherwise, there's arbitrage opportunity, and market force is going to wipe away this arbitrage opportunity, driving the same level of risk to the same return. Okay, we talk about opportunity cost of capital. Opportunity cost is a really important economic concept. What is the opportunity? What is your opportunity cost of coming to class? Well, it might be watching a movie, the benefit you get from watching a movie. What is the opportunity cost of spending 4 years in college? That might be the loss of income if you went to the workforce full-time. Okay, so the opportunity cost of capital is the return we didn't earn from another investment with the same level of risk, because we got to compare apple to apples. In bonds, we use yields, which is just the same as return. Yields for bond is return for other investments. If the investment opportunity we have in mind is a treasury bond with 10 years left until maturity, Well, it could be a 20-year treasury bonds, it's already 10 years into its life, 10 more years left until maturity, or it could be a 10-year treasury bond freshly issued. And if this is a bond we're considering, the appropriate interest rate R could be the yields of another treasury bond with 10 years until maturity, or the return of similar level of risk from another channel of the economy. For example, if you compare investing into golds, it's also a safe investment. Or you can also buy bonds from a foreign government with about the same level of creditworthiness as the US government. The bonds is a type of fixed income security because we know exactly when we're going to get how much cash flow. We know exactly how much coupon we're going to get when from the start of our investment in the bonds. So the only thing that can change is the denominator into the pricing formula. If the interest rates in the economy changes for whatever reason, the opportunity cost of investing in the bonds is going to change. And then the bond yields changes. When the bond yields changes, the denominator of the pricing formula change, and then because the numerator is fixed, we have the results, which is the price of the bond change. Because the interest rate is in the denominator of the pricing formula, when the interest rate goes up, the bond price is going to go down. And when the interest rate go down, the price is going to go up. That's why every time you hear news about interest rates, bond prices, you got to think in reverse. When the interest rate is reported to going up, you see the prices for bonds drop, and vice versa. We all know interest rate varies. If you open the news, and there's a lot of discussion about how rates is increasing these days, and asking the Fed, are they going to increase the rate to curb inflation, or are we there yet? Should the low interest rate be there for a while before the economy fully recovers? Why does interest rate varies? Well, first of all, what is interest rate? Interest rate is the price for money. If you think about it, when a borrower demands money, they go to a bank and they pay the bank interest, and they can get the money they want today. The higher the interest, the lower the likelihood that someone wants to borrow from the bank because it's too costly. Okay, on the other hand, if we have the money, we can sell it to someone who needs it by charging an interest rate. So interest is really the demand and supply result of funds or money. If we look back one particular economy, such as the US, we can see that the interest rate in the economy varies throughout time. For the US, there were episodes of really high interest rates, and especially when inflation was high. So the Fed stepped in to increase interest rate to increase the cost of money in the economy. So there's lower demand for money, and lower demand for money, lower purchasing, and less pressure on the increasing price levels, which is what interest rate about. And how does the Fed change interest rate in the US economy? Well, this is entirely optional, but I want you to have an idea of what forces the Fed have, what powers they have to change the interest rate in the economy. Next time we hear someone interview Jerome Powell, we know that what kind of things he can do and what is his pressures from the market. There are three things the Fed can do to change the price of money in the economy. First of all, they can join in the market by demanding or selling more treasury bonds. This is called open market operations. If they want more treasury bonds, they buy more treasury bonds, they're infusing more money into the economy. There's a higher demand, there's a higher supply of money when they buy treasury bonds. When there's higher supply in money, the price of money dropped. Okay? The price of money dropped, interest rate dropped, and the price for treasury bonds is going to increase because there's more demand for treasury bonds, and vice versa. The second tool they have is a bank reserve rate, which is a percentage of fund the bank must put in their reserve, and all the rest they can lend it out. If the Fed asks all the commercial banks to increase their reserve rate, that means they can lend less money into the economy. And in this way, they can change the flow of money into the economy. The third way is a Fed funds rate. This is what we talk about the most. The Fed funds rate is the basis interest rate in the US economy. In last year, up until recently, it was very close to zero. The Fed funds rate is what all the other banks, all the commercial banks, borrow from the Fed, which is a central bank. Well, if you think about it, a commercial bank, they borrow money from the Fed. If the Fed funds rate is high, their cost of capital is high. And then when they lend their money out to invest to individuals, to other borrowers of the commercial banks, they're going to charge a higher interest rate. So this higher Fed funds rate is going to cascade into a higher interest rate in the economy, and vice versa. Fed typically want to decrease the interest rate when the economy is not doing well. By lowering the cost of money, they can infuse more money into the economy, boosting the economy. When people have money, when it's easier to borrow, they have money to spend. So that's a positive force behind a weakening economy. When the pandemic just started in last spring, Fed started to cut rates, and they cut the Fed funds rates all the way to close to zero. Because the Fed funds rate is close to zero, all the other interest rate, which is based on the Fed funds rate, all the other interest rate is basically the Fed funds rate plus a premium, is lower, so that the cost of money in the economy is generally lower. For example, the mortgage rate is much lower, and it actually boosted the demand for housing. A low interest rate policy is also called an easy money policy. It's easier to get money. Nowadays, recently, 1 year after the low Fed funds rate, we're beginning to worry about inflation, especially because the stimulus package signed by President Biden. And people were pressuring the Fed to increase interest rate to curb inflation. Well, we're still waiting to hear from the Fed chairman about the future Fed interest policy. But from his most recent speech, he said that we're not there yet. They're going to be low interest rate for a while. We're not increasing the interest rate because inflation is still very low and the economy is still very weak. Let's look at the pricing model for bonds again. The coupons and the par value are fixed. The cash flows, the numerators were fixed. So the relationship is really between the change in prices and the change in yields. We already talked about how yield changes, either from the Fed or from other influences, can change the price of bond. On the other hand, if there are market forces which is changing the price of the bond in the market, it's going to have effect on the yields as well. Because the equation have to balance. When price changes, yields will change too. And they have an inverse relationship. When bond prices goes up, bond yields will go down. When bond prices go down, bond yields will go up. Let's look at one example from also last spring. When the economy is beginning to shut down because of the pandemic, and there is a phenomenon, what we call the rush to safety. This often happens when the economy is going into a downturn. The stock market faces a lot of uncertainty. We don't know how big an effect of the COVID is going to be on the stock market. And as an investor, we don't like uncertainty. That's also a really important phenomenon in the capital market, is people don't like uncertainty. When there is uncertainty, people panic, and people want something that is more certain in terms of investment outcome. So there's more demand to US Treasury bonds because that's a safe investment. The same happened for golds. When there's more demand on the US Treasury bonds, the yields are going to drop, the price is going to increase. Higher demand, higher price, lower yields. That's also one force behind the lowering yields before the Fed even did anything. we're seeing a lot of activities from the market these days. And because the market always want to anticipate what the Fed is going to do. For example, the rate is very low right now, and the market is anticipating an increase in interest rate from the Fed. What happens when the interest rate raises? Well, the price of the bonds drop, right? And we don't want our asset at hand to depreciate in value. So before the Fed even increased their interest rate, there is going to be some selling forces on the bonds. I'm talking about nowadays. This newsletter was from last year. It was in the reverse. That we know that if the economy is going into trouble, the Fed is going to drop their rates sooner or later. So why not just buy bonds now? Because when they drop the rates, the bond price is going to increase, our asset is going to appreciate in value. We're jumping back and forth a little bit from last spring to nowadays. Recently, we see a higher interest rate. The 10-year Treasury yield is set to have rebound back to the near high for the year. And the main reason is the stimulus package recently signed by President Biden. Well, how can a stimulus package from the government lead to a higher interest rate in the market? What is a stimulus package? It's basically a bunch of cash flow into the market. When they give this check to individual household, the household is going to spend the money to buy stuff. When they spend money, the money goes into the market. It's demand. It's pushing the prices level high. So the stimulus package is led to the worry of inflation. As a fixed income security, bond is a fixed income security because all the cash flow is fixed. And when inflation is high, a fixed level of future cash flow can make us worse off because it doesn't grow with the inflation rate. The same amount of money is going to buy us less goods. So fear of inflation will have a negative impact in the value of fixed income securities. There's less demand for fixed income securities. Less demand meaning lower price meaning higher yields. On the other hand, we are showing an increasing level of confidence in the market. When the market has more confidence, more positive outlook into the economy, people are less likely to stay with those safety investment options such as fixed income securities, bonds, or golds. They're more likely to participate into the market, into equity market. So there's less demand for bonds. Those two reasons combined lead to a lower demand for treasury bonds. Okay, now let's put things in number and see how does changing interest rate relate to changes in bond price. Here is an example. What should be the price of a 1.25% annual coupon bond if the appropriate annual interest rate or the discount rate is 1.25? From the formula, we know to discount each coupon by the interest rate. It's an annual coupon, so we're using annual coupon numbers discounted by annual interest rate. Okay, there were 3 years. And we find out that the present value is actually $1,000. And we can easily verify it using clear. And it's split. Okay, sorry, in the question I forgot to put that this is a 3-year bond. 3 years, interest rate 1.25. PMT is the coupon rate multiplied by par value, which is 1.25% multiplied by 1,000, which is 12.5. Okay, you can use the calculator for this step as well. This is a PMT. FV is $1,000. And then compute PV. $1,000 verified. When the price of the bond is the same with par value, we call this bond at par. What should be the price of the same bond if the interest rate has changed to 1.110%? if the interest rate had dropped? Well, this can happen for many reasons, like we discussed. Maybe the Fed had lowered the interest rate. Let's see what is the result. Using the financial calculator, we have here everything. The same 3, 1.1 IY, 12.5 PMT, 1000 FV. Compute PV. Okay, we see that the price of the bond is now $1,004.40, and it can be quoted as 100.44%. When the price of the bond is higher than the par value, we call this bond to be at premium. When the price is higher than par value, we see that we have a lower interest rate now and we have a higher price. The inverse relationship between interest rate and bond prices. Let's see, what if the interest rate suddenly changed it to a really high level like 10%? The Fed increased the interest rate, for example, for whatever reason. There's hyperinflation, we just want to curb the inflation, so we raise the interest rate to super high. Let's see what it does to our bond. I do recommend clearing your financial calculator and enter into everything from scratch to avoid any mistake. 3 and 10 IY, 12.5 PMT, and 1000 FV. Compute PV. Alright, now the price of the bond had dropped to $782.40. It's much lower than the par value. We call this at discount. A bond is at discount when the bond's price is lower than the par value of $1,000. Higher interest rate, lower price. To summarize, for the same bond, when interest rate rises, price falls. When interest rate drops, price increases. One thing to emphasize here is that the changes in interest rate as a discount rate only affect the present value of the bond payments, the coupons and the par value, but not the payments themselves. Bond is called fixed income security because the payments are fixed no matter what. From the previous 3 examples, we can kind of see another rule of the relationship between bond prices and interest rate. In the first example, when we had the discount rate to equal to the coupon rate, we can see the bond is issued at par. When the discount rate is lower than the coupon rate, the bond is at premium. And when discount rate is higher than the coupon rate, the bond is at discount. So to summarize, we know that when the market interest rate for the bond exceeds the coupon rate, the bonds typically sell for less than the face value, and we call this bond to be at discount. When the market interest rate is below coupon rate, bonds sell more than the face value, and the bond is set to be at premium. And when the market interest rate equals to coupon rate, bonds sell for the face value, which we mean at par. But no matter what is the path of price for a bond, at maturity, the bond price is always $1,000. Why? Well, if you think about it, when you are at the maturity date of the bond, all the previous coupon is already paid. The only thing that hasn't been paid out yet is $1,000, and they're going to pay you right now. If someone's paying you $1,000 now, how much is the present value of this cash flow? Because it happened exactly right now, it has the same value. It's $1,000. So at maturity, the price of the bond is always $1,000. That being said, we know that if a bond's price is lower than $1,000, it's going to gradually increase, and at maturity is $1,000. On the other hand, if a bond is at premium, the price is going to drop slowly, eventually it's going to be $1,000. Okay? But it doesn't have to be a smooth line like this. This smooth line, the monotonous line, is actually a special case if the bond yield to maturity does not change. Then bond prices will steadily approach par value as time to maturity decreases. But if the yield to maturity changed because of the interest rate in the economy change, there could be up and downs in the past, but eventually it's going to convert to $1,000. By now we know interest rate changes bond prices. When the interest rate in the economy change, the bond price is going to change. As a bond investor, when we already bought the bond, we are facing this uncertainty from interest rate changes because our asset value is going to change with interest rate. We call this interest rate risks. Later in chapter 11 and 12, we're going to define risks as uncertainty, something we cannot forecast. And the interest rate faced by bond is not the same for bonds of different maturity. And the longer the bond's maturity, the higher the amount of interest rate faced by the bond. Why? If we look at the pricing model of the bond, we can see that it's the present value of all the future cash flow. The last cash flow is a par value of $1,000. And the par value is actually the largest amount of cash flow in the bond's cash flow bundle. The longer the maturity, the further away this par value is going to happen. And the more heavily this par value is going to be discounted back to present value. Okay? And mathematically, if we were to take a derivative of the last term, it's going to be increasing with t. The derivative is the rate of change, the sensitivity of the price to interest rate. So the higher the t, the higher the sensitivity of the change in price to interest rate. That's what we call interest rate risks. So the longer the bond maturity, the higher the interest risk. A 30-year treasury bond is going to have a much higher sensitivity to interest rate change as compared to a 3-year treasury note. Okay? That means a fixed percentage change in interest rate is going to cause a much larger price change in a longer term bond as compared to a shorter term bond. On this graph, we can see that the change of interest rate to bond price. And the slope of the price path for a 30-year bond is much steeper than that of a 3-year bond when they have the same interest rate. Okay? The same degree of interest rate change has a much bigger impact on the price of a 30-year bond compared to the impact of a 3-year bond. Okay, that's the first part of chapter 6. There's a lot of content, so I want to stop the first part here. And in the second part, we're going to focus on yield to maturity, rate of return, yield curve, and corporate bonds. I might have assigned the readings from 6.3 to 6.4 in the first chapter. If you already read it, that's great, because you don't have to read it for the second part. And in the homework, if there are homeworks about yield to maturity or bonds rate of return, which you don't understand yet, you don't have to do them now. I have extended the due date for the homework to until week after. So the two homework from chapter 6 are due both at the end of March. I think it's March 28th. Okay, that is for now.